In this video, traders, we're going to talk about 5 pieces of advice that all pro traders will tell you. Stick around. Hey traders, warm welcome to you. All right, so this video came about where I was listening to a podcast with an interview with Toby Crable. I can't remember the name of the podcast, should do. But if you Google, or if you go into Apple Podcasts or Spotify and put in Toby Crable, I think he's only done one. And Toby Crable, hedge fund manager, has got 8.5 billion assets under management. He talked that his work is like a narrow range 7 type stuff, and the opening range drive, opening range breakout type trade. And the reason I was kind of studying him a bit more and listening to his podcast was, and he said so many things in this podcast. And by the way, this guy, seriously good trader, has great returns, hedge fund, etc. at the pinnacle of his career, and he's saying the same things that you hear in the Market Wizards book, the same things that you know are true, you've heard you on YouTube say, you've seen in courses, and whatever level you're at, if you've had some consistency and some success in the market, then you know these to be true. And so if you're kind of struggling and things aren't working for you, then just look at these and go, actually, if the majority of traders, or all pro traders, are telling me this, I should probably listen. And it's really worth taking these on board, guys. So the first thing is keep position size small. So there's a bit of confusion sometimes, like, well, why is that? The name of the game when you're starting trading is to stay in the game long enough to learn the game. That's it. That is it. There's nothing else for you to do other than stay the distance, 1 year, 2 years, 3 years, 4 years, whatever it takes. And the only way you'll stay in the game is if you have the capital to stay in the game. That's why trading small is so key, because if you trade too big, you haven't got the skills yet, your emotions are all over the place, you're very likely to lose money. And that's not what you want. You want to be able to stay in the game, and you choose how much you pay for the lesson. You choose how much to pay for the education. Unlike if you went to Harvard, unlike if you go to Oxford and you pay, they tell you how much to pay. They say, this is how much it's going to cost, you have to pay. The market tuition is a little bit different. You can choose how much to pay. Why not choose to pay a little amount and say, okay, my job is I've got this trading capital. If I trade small, I can stay in this for 1, 2, 3, 4 years. Maybe I'll invest in some courses. Maybe I'll invest in joining Traders Mastermind. But I mean, whatever it may be, I'm messing around with you guys. But the point is that, you know, if you can stay in the game long enough, then you'll learn trading, and you'll learn it by doing. But if you scale up, it's too big and too much size too soon, you get wiped out. So it's emotional capital, keep that topped up, and your actual financial capital. If you keep those two topped up, you're in a great position. Number 2, sit on your hands. So it's so important to not overtrade. It's so important to hold a trade to expiry, or to its final target, should I say. It's so important to give yourself the opportunity to make these outsized returns in terms of R multiples on trades that have a propensity to do that. Now, some of you guys are saying, well, I'm just scalping and trying to take this and that back and forward, and that's okay, but then that might apply for not over trading in terms of, hey, well, stop taking substandard trades. Only take trade. Don't take punts. Don't take a stab at something. Say, well, this is a setup I would absolutely take. I'm going to take it. And until I see that, I'm not going to take it. And every trader says this, guys. Every trader says that, you know, sitting on your hands and not touching the market when you don't see your setup is so key. Sitting on your hands when you're in a trade and you wait for it to hit target. I don't care if that target's 10 ticks or if it's 10,000 ticks. If that's the plan, then you sit on your hands. Every trader says this, and it's so key. And 3, hold your winners. So this might mean giving yourself the chance to make 10R on your trade, 5, 6, 7, 8, 10R on your trade. Because if you cut your winners too early, you never give yourself a chance to get those outlier moves and outside returns on the risk you're taking. But some traders aren't, as I said previously, some traders aren't in that realm. They don't trade that way. But what it also means is holding your winners in terms of, hey, I'm doing well in the market, let me keep pressing. This strategy is working, don't give up on it yet, keep moving. I think that's the way that I interpret it when some traders are saying that. But in reality, I do think that whatever you're trading, give yourself the opportunity to make a multiple of R, on whether you're scalping, whether you're day trading, swing trading, and the right environment, the right trades, just gives you that extra boost, just helps boost that P&L, so holding on to the winners. Okay, this is an interesting one. Many traders have said this. Jim Simons said this. Toby Crable mentioned something similar to this. Some of the big titans out there have said this. So use tools, strategies to minimize the impact of emotion. They didn't say this, but this is my take on it. So Jim Simons basically said, hey, the emotion of investing is detrimental to my performance. I'm paraphrasing here, but that's one of the reasons why he started quantitative hedge fund or quantitative strategies. He wanted to remove the emotion from trading, from investing, and so using algorithms and automation to do that helped him. Toby Crable said the same thing, and again, paraphrasing slightly, in that, emotions get the better of you, so automation removes emotion. Now, I'm not suggesting you go out there and you create an algo, absolutely not, because it's not for everybody. But how can you use tools and strategies that help you? You're still human. We can't suppress everything. Yeah, we can get better at understanding our emotions and the impact on our trading. Of course, we talked about that so much, guys. But how can we get better at saying, well, actually, this short-term aggressive momentum strategy at the open really riles me up. So maybe use a strategy that minimizes the impact of emotion. And when we look at the tools perspective, maybe that is kind of using a basic trading stop to not get taken out of a trade until that trading stop's hit. That's a tool that helps you stay emotionless. I won't do anything until that trading stop is triggered. Or maybe you have a filtering criteria that brings ideas into you. Or maybe you have a very basic algorithm that says, hey, this is a good time to trade, or whatever it may be. Now, I'm not suggesting, of course, that you go and start up a quantitative fund, but if you look at all these traders who have said, hey, they're not emotionless, they recognize emotions play a part. Now, many of them are good at understanding and appreciating these emotions, and there's some great discretionary traders out there, but a lot of them say, how do I get around it? How do I do something to get me to the goal I want, which is to make money in the market? Do I need to create a little tool that helps me trade in the right environment, or helps me run the trades, or helps me not overtrade or something? So just think about that. Or the strategy, day trading, but super hyperactive and scalping, and maybe that's the worst thing for you. I don't know. Something to consider. Final thing, guys, is know your edge and strategy. I think this is key. I think the many traders who have what we consider success in the market know where they sit in the ecosystem. They know where they sit in the pool. It's a big pool of traders. Everyone's doing their own thing. They know what they're good at, and they become very, very specialist at it, and they don't deviate. And very often you hear in these interviews, the time that they struggle is when they have deviated. And they've gone, oh, I'll just do this and do that, and I'll have a dabble at this and I'll have a dabble at that, and it just hasn't worked for them. The ones that do very, very well is say, this is what I'm good at. I'm going to focus on this exclusively and get better and better and better at it. So maybe it's something for you to consider. Maybe you go, you know what, actually, and you might not know that yet, but maybe you go, you know what, I'm just going to focus on this. I'm just going to focus on becoming the best trader in this environment, in this specific circumstance, in these conditions, in this setup as I can, and then I'm going to iterate, and then I'm going to improve, then I'm going to add something else into it. So I think that's so key. All right, guys, 5 pieces of advice that I think all pro traders will tell you. Keep your position size small so you can stay in the game long enough. Simple kind of rule there. Sit on your hands, not over trading. Hold on to your winners if you can. Using tool strategies to minimize the impact of emotion, i.e. adjusting your strategy if it's causing too much emotion, using some kind of tool to help you manage those emotions. And 5, know your edge and strategy. Follow those and you've got a good chance. Take care, keep your risk managed. Bye-bye.